Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Time to go over the income-oriented landscape on the US stock market. So this is obviously for my American friends or for you Canadians or those of you who invest on the American stock market. Remember, in the RSP, there's no 15% withholding tax for us Canadians. So let's check out what the market has done in the last month. It's been a pretty good month for pretty much every major index in the US. We'll go over the three major ones. S&P 500, of course, probably the most general and diversified out of the three, up about 4%. By the way, I'm filming this on February the 11th, just to give you the context. NASDAQ up a little bit more. It was a really nice month for technology. This technology index, right, in quotes, but it's about 50% technology, up 4.76%. Russell a little bit lagging, but still doing well, up just under 4%. So, as usual, what we'll do is go through the income-oriented funds with a very specific focus on the diversified ones. And in the US, the most popular vehicle or style is index-based. So let's do the S&P 500 ones first, then the NASDAQ, then the Russell 2000, and then a couple of other alternative ones. So let's go through them, guys. So we're gonna start with the S&P 500 derivatives. These are not exactly the S&P 500 index, but they're kind of stock picking in the S&P 500, so pretty close. But of course, we have JEPI, which is still number one in terms of AUM. I believe almost at 40 billion. Latest distribution, which of course varies based on volatility and other factors, a little bit lower than the last one. Not really surprising here. If we move on, Bali, this is pretty much the BlackRock or the iShares JEPI, which I feel is actually doing much better. The yield is about the same. And by the way, going forward, I will start comparing total returns for these, and as time goes on, once they've all hit a year, we'll have more data to see which ones really are doing the best in terms of performance, of course. And then you have the Invesco S&P 500 equal weight S&P 500. So this is for people who want the S&P 500 but more equal weight, because we know like the Magnificent Seven makes up a giant chunk of it, and the yield's a little bit higher on this one. We're talking about in the nines here, 9.5. So if we compare these three S&P 500 derivative type ETFs, Bali seems to be doing the best so far. The equal weight, the Invesco one, hasn't been out for a year yet, so we really won't know till that one comes out. But if we just do Bali versus JEPI, you see that there's a really big performance discrepancy here. So obviously the hats off to BlackRock for making it work the best so far. So moving on to the classic S&P 500 index covered call ETF. So these are really, this is the S&P 500. It's not like JEPI or Bali or the other ones where they're stock picking inside of it. It's not exactly the S&P 500. These are the S&P 500 classic, I call them. So classic covered call strategy, not daily covered calls. We're going to focus it on the next group. So before we continue, I'd like to take a moment to thank the new sponsor of this video and monthly series, Tidal Financial Group, who's the custodian of several high yield income oriented ETFs on the US market, like YieldMax, Defiance, etc., etc. Speaking of YieldMax, by the way, they've launched, very exciting, their first zero DTE or daily covered call strategy ETF, SDTY, which focuses on the S&P 500. So this is YieldMax first ETF that uses daily covered calls or zero DTE options on an index on the S&P 500, and it's actually going to have weekly payouts. So I'm very excited because I'm going to be doing a Q&A with the man himself, Jay, shortly, and ask him all about this. And another one as well, in case you missed the video where I talk about the FIRE ETFs, these are also under Tidal's umbrella. If ever you really like that 4% rule, you like that whole premise behind the FIRE community, these two ETFs have been specifically designed for that community. So make sure to check out the video where I do an in-depth analysis of these two ETFs, and I also do a Q&A with Mr. Michael Venuto from Tidal to discuss these two ETFs in detail. Of course, you have GPICs, The Goldman Sachs one, your base one, which has continuously approximately 8% yield, very low fee, same fee as JEPI, and very consistent monthly distribution. So definitely a good one here. Of course, you have SPY, which is a favorite in the community because it also has very, very consistent distributions at about 12% yield annually or 1% a month. It's about to crack $3 billion. So obviously very, very popular. Then you have the lowest fee one ever, 25 basis point fee from iShares, IVVW, which all they do is a rinse and repeat 1% out of the money covered call every single month. So obviously this one's going to have a lot higher yield because they're writing more covered calls, right? You're giving up more upside, but very, very fluctuative. I don't think that's a word, but maybe I'll make it up. And by the way, hit that thumbs up button. I would really appreciate it, everyone. So lots of fluctuation in these monthly distributions here. And I decided to put YieldMax. So YieldMax in this category. So YieldMax is definitely not the S&P 500. It's a collection of YieldMax ETFs and another, single stock and other ETFs as well. But, it has a lot of the same stocks. Obviously, they're all in the S&P 500, Tesla, Apple, Nvidia, et cetera, et cetera, et cetera, et cetera. So just very hard to fit it in a category. But because the YieldMax, the ETFs inside of it, don't do daily covered calls, I figure I'll just put it in this category. So if we compare the four, everyone, GPIX, SPY, IVVW, and YieldMax, IVVW is going to be out. It's going to have its 1 year anniversary next month on March the 14th. So probably not in the next episode. The episode after we'll finally get a year of data. But GPIX doing really, really well here. Slightly has a slight edge over SPY, but YieldMax is doing extremely well in the last year. It does have, MicroStrategy and Coinbase. It has a little bit more, since it's equal weight of the YieldMax universe, it's going to have a little bit more exposure to things like MicroStrategy, Coinbase, Nvidia, which have done really, really well. So obviously YieldMax done really well, but in terms of your classic S&P 500, GPIX is really, for me, the benchmark. I always choose GPIX or even SPY as sort of a benchmark. So that's it for these ones, the classic ones. Moving on to the daily option strategy. So these are the S&P 500 covered call ETFs that do a 0 DTE or daily strategy. You have JEPY, which turned into now WDTE. SPY-T, which I like much better because it targets 20% yield. So the monthly distributions are very, very consistent because they target 20% annually. And of course, you have XDTE as well with weekly dividends, weekly distributions. Not consistent, however, but not too all over the place, but it really depends on the volatility, right? They're fairly consistent, I would say, but not 100%. And then you have, I believe it's the lowest fee daily S&P 500 covered call ETF from ProShares at 55 basis points, right? Yeah, 55 basis points. iSpy, and this one also has distributions are not consistent. You could see the monthly ones here, and the latest one for 2025 is 32 cents, pretty high. So also there is T-Spy. So T-Spy is definitely a good competition. It seems to be doing really well. Expense ratio is the same as SPY. And this one has it's been out for 4 or 5 months. And the distributions have been very, very consistent. So definitely got to keep our eye on this one. And we have a new one to the game. The first YieldMax 0 DTE. Or daily option covered call ETF, SDTY. And I believe there's going to be a NASDAQ and a Russell one. I'm just guessing here, but I'm pretty sure there's going to come out with them. And stay tuned because once they do come out or in a week or two, I'm going to be talking to Jay all about this and see how it compares to YieldMax and its competition. And by the way, this is going to have weekly distributions, just like XDTE. So if we compare all of these, except for the new one, because there's not much data, even T-Spy, many of these have not been out for a year, guys, so we really got to wait for a year for the full data. But if we look at the 3-month here, XDT, of course, still doing really, really well. But T-Spy giving a run for its money. So XDT and T-Spy are kind of in a dead heat. and but they're really the top ones in terms of performance. Moving on to the NASDAQ 100 income-oriented covered call ETFs. So of course we have QYLD, right? The OG, the classic, which is still growing. Unbelievably, I think this strategy is antiquated, but hey, they're still going and pumping out those monthly distributions with a rinse and repeat strategy, right? Which I've gone over a million times, so I won't do it here again. You got JEPQ, which I like much better than JEPI, by the way, because it's much closer to the NASDAQ 100. And the latest distribution was the same as the last one at 45 cents. So you're looking at about 9-10% yield typically with this one. Then we have the classic. So remember, JEPQ is NASDAQ 100, but not the entire thing, just like JEPI is not the entire S&P 500. But this one is, here's the classic, or the one I like to consider my benchmark for comparisons, the Goldman Sachs one, which again, very consistent, approximate 10% yield with very consistent monthly distributions. And you see that here, a little bit higher, which is great, doing really well. QQQI, the NEOS one, I believe, it's doing really, really well performance-wise. We'll see that in a second. So exact same management fee and strategy as SPY-I, but it's just on the NASDAQ. And of course, the NASDAQ's more volatile. So you got about 14% annual yield, very consistent monthly distributions as well here. And you have Invesco, who manages, QQQ and QQQM. They're I don't know if they're the inventor, but of the NASDAQ 100 index, but they're definitely the main players with that index. And they have their own now called QQQA, which is just NASDAQ 100 with cover calls, and you're looking at about 10-11% yield as well. So if we compare them, and again, QQA, this one has not been out for a year yet, but we have a year of data for all of them. And you see that the winner is QQQI. NEOS is actually doing the best out of all of them, but it's very, very close. JEPQ, GPIC doing really well. QYLD in last place. And I expect as time goes on, QYLD will fall further and further behind because it gives up all the upside. So if the NASDAQ keeps going up very strongly, QYLD is obviously going to underperform here. But still not too crazy bad here at 19%. But yeah, QQQI and GPIC, the strong ones here. We don't have enough data for QQQA, unfortunately. So that's what I would call the more classic covered call NASDAQ 100. Let's move on to the daily one. So of course we have QQQY, the one with the highest yield here. Typically weekly payouts. QQQT, which does the same thing as SPY-T, targets a 20% annual yield. Of course, you have my personal favorite, QDTE, weekly distributions, just past 750 million in AUM, so it's doing well in terms of AUM. You got the ProShares one as well, IQQQ, same thing as iSpy, but with the NASDAQ 100 index with the same fee, so low fee. That's definitely a positive here. And what's the latest distribution? 45 cents. And the last ones, if we look at 2024, yeah, so pretty high compared to the last ones. And if we do a total return, and by the way, guys, in case I forgot to mention, these are total returns. This is with dividends reinvested. So this gives you the full picture of the actual performance. And a lot of these, 3 of these here have not been out for a year, but they will celebrate their 1-year anniversary soon. So maybe in the next couple of episodes, we'll have this data. But if we look at the 3-month, you see that QDT is pretty much doing the best still out of all of them. I wonder if T-SPY, I think T-SPY is going to come out with a NASDAQ version as well, or TAP Alpha. T-SPY is the name of the ticker. So that's it for the NASDAQ 100 covered call ETFs. You got a bunch of them here. So obviously you got to pick the ones you like the best, which ones are best suited for you, depending on your extraction rate, if you're living off the income or just dripping them, etc., etc. But it still seems like QDT in terms of performance is number 1. Moving on to the Russell 2000 index, small cap companies, 2,000 of them. So you have the BlackRock one here with the lowest fee. So they do the same thing as IVVW, but except it's 2%. Where is it? 2% out of the money instead of 1% out of the money. So this is a rinse and repeat strategy. Very, very high yield, of course, because the Russell 2000 is much more volatile, and they're doing a 2% out of the money call, which, is quite heavy on the covered call here for the Russell. You have the NEOS one, which is slightly higher yield than the NASDAQ one. Very consistent distribution, 68 basis points. You have IWMY, which is the daily option one. They don't have a 20% yield target. They don't have a SPY-T or QQQT version of the Russell one. They didn't come out with it yet. I don't think they will because it seems like this one doesn't have too much interest here. Oh, well, it has 114 million, but I'm not sure if they're going to come out with that 20% target. Round Hill has, of course, RDT, which is very similar to QDTE and XDT, except it's on the Russell. Same management fee and weekly distributions, but varying distributions. You could see them here. They're fairly consistent here, but sometimes you get a big jump and whatever. And then you have ProShares. So ProShares also has their own Russell 2000 one here. Same fee, right? 55 basis points, I believe. And of course, varying monthly distribution. So a lot of these are a lot newer, guys. We don't have as much data for the performance analysis. So I'm going to hold off doing the comparison because I think none of them have been out for a year. YieldMax we already covered. So YieldMax, now we're moving on to more alternative and different things that I would say don't fit under the category of index. But YieldMax, I kind of put it with the classic S&P 500. So I'll remove it from here. You have GIAX, which if you want some global exposure, so yes, the S&P, the NASDAQ, the Russell 2000 are great, but for investors, if you're an American investor that really wants income but a little bit of global exposure, you have GIAX, which is, by the way, under the Tidal Financial umbrella, right? The sponsor of the video here. And if you scroll down, you could see that they have fairly good distributions, consistent distributions, fairly high as well. What's the yield on this guy? About 24%. So in the low 20s, low to mid 20s in terms of yield. But if you look at what it has, it's kind of like an all-in-one because it has the S&P 500. It has a Vanguard Technology ETF. So obviously they're very bullish on this and they could write calls on this. Here's a mid cap, right? Mid cap is not exactly small cap, but it's mid cap. Here's VIG, right? The VIG ETF, dividend appreciation, 11%. And you have some single stocks. Here's NVIDIA. Here's an Israel ETF. Here's an emerging markets, an Argentina, Tesla, Amazon. I'm sure you could download all the holdings, but this gives you what seems to be mostly U.S. exposure with a little bit of things outside the U.S. So this could be a good one if you want a little bit of diversification geographically, that is. Moving on, SVOL. Now, SVOL, still a little bit controversial here, but the distribution rate is still very high in the high teens. And I believe they re-increased their distribution by a cent. So it's been going down 30 cents to 28 to 27 to 26. But then now they bumped it back up to 27. And I think that trend is going to continue because from what it looks to me, guys, they're going more and more towards equity and actually towards the S&P 500 and removing a lot of their short-dated bond treasury exposure. So you see that the short-dated bonds here, hopefully my face is not blocking this. I apologize if it is. It's a much lower percentage than it used to be, but there still is some fixed income in here. You have this ETF, these ETFs here. They're all fixed income, right? Here's some small cap, just a little bit though. US Equity Plus, here's a nice chunk, and then they actually have the SPY, and they're writing, I believe, calls or puts, here's the puts on the SPY, while still doing their short VIX strategy. So hopefully this trend continues, and my opinion is I think they should just drop the fixed income entirely and just go with the VIX strategy plus S&P 500 calls and puts or spreads or whatever. Just put it all 100% equity. I wish they would do that. And if they did, I'm sure they could re-raise the distribution back to 30, 32 cents. But definitely a good, in terms of performance, not super great in the last year versus the S&P 500. You see the 1 year performance here, much lower, probably half about half of the S&P 500. If we look at the S&P 500, let's look at the classic ones. Let's go back and check here. It's 22% in 1 year. So yeah, 9%, not that great. But this is because of fixed income. It killed it. So hopefully they change the strategy. But I'm not going to be covering fixed income anymore, like TLTW and all that, because I think it's just garbage. I think fixed income is pure nonsense to hold. It makes no sense. Might as well hold just the S&P 500 with covered calls if you're a conservative investor. But if you want to add a little bit of fixed income or it makes you feel better, I would still go with SVOL as that little diversifier. Moving on to a couple of the popular rec shares niche or sector specific ETFs. So you have FEPI, which is, I would say, classic technology, which is doing okay in terms of performance. It's definitely not beating the NASDAQ 100. That would be my preference instead of holding this. But you got a lot of technologies. You got, mostly the classic technology stocks. You see the 1 year performance is 15. NASDAQ 100 is much higher than that in the last year. But hey, if you like technology, if you really just want to get technology stocks with covered calls and a nice 25% yield, fairly consistent payouts as well. FEPI is definitely one. EIPI is the same kind of concept, but more focused on AI stocks. So they're more volatile, which is why they have a higher yield of 35. You could see some stocks here. So of course, you're going to have more AI type stocks, a big chunk here in Palantir, CrowdStrike, et cetera, as well as some chips and more classic tech stocks as well, like Meta. And they also have a crypto one, which has, the highest yield because it's, crypto related stocks though, however, not just random tokens and garbage. So you see there's Robinhood, there's Visa, there's MasterCard, Coinbase, MicroStrategy, which is now Strategy Riot. So anything that has to do with crypto related activities, like it says here, cryptocurrency mining, trading, custody, blockchain. So this is a good way if you want exposure to this whole crypto new asset class without buying Bitcoin directly or anything like that. It's a good idea, definitely a good idea with a nice high yield so far, but this is pretty much brand new. Moving on to classic Bitcoin, which is the last thing I want to cover here. You have YBTC, you have BTCI, and you have Maxi in terms of your Bitcoin yield style. ETFs. Of course, you have IBIT if you just want classic Bitcoin. But I did the comparison because YBTC and Maxi have been out for a year, not BTCI. And you could see that obviously Maxi is doing a lot better than YBTC because it's been an incredible bull market. YBTC is writing covered calls on Bitcoin. Maxi does not do that. Maxi just holds Bitcoin exposure and writes... let's see here. Bitcoin exposure will vary between 50% and 200% of the funds. And then they're going to do, they basically do call spreads to add a little bit of income to it. So this is kind of like, you could see all the call spreads here. MicroStrategy, here's the NASDAQ, the Russell, the S&P call spreads. So they're doing more classic call spreads just to add a little bit of income while getting exposure to Bitcoin. So you're not giving up as much, or if at all, Bitcoin exposure versus a Bitcoin covered call ETF, which is what these two do. So obviously, Maxi has done phenomenally well versus a Bitcoin covered call. And we don't have a 1 year for the NEOS one because it just came out, but you could see year to date and even in 3 months, it's actually outperforming the Roundhill one, YBTC, which is the only one that has the weekly distributions. BTCI and Maxi have monthly distributions, and I believe Maxi went back to their original 15 cents a month. Yeah, they did. So typically they always give a big bonus or they increase it near the end of the year because they had so much capital gains. But it seems like it's going to be back at 15 cents a month. But my prediction is probably by August, September, October, if Bitcoin keeps going up and up and they have a lot of capital gains, they'll probably increase it here. So this is a good one if you really want Bitcoin exposure with some yield, but you're very bullish on Bitcoin. You don't want to give up a lot of upside, which is what covered calls do. So hopefully that makes sense. So thanks for watching, everyone. It's the income landscape overview. I know there's a million more funds I could talk about and discuss, but again, I really got to focus more on the ones I feel are diversified, index based, that could make up the foundation, or should make up, in my opinion, the foundation of your portfolio, right? S&P, NASDAQ, Russell 2000 if you want some small cap, and then a couple of these alternative sector ones as well. So give the video a thumbs up. I would really appreciate it, everyone. We're gonna do this again next month, so see you next time.